Hello everyone. So people who've been following my channel will know that I've been explaining about share trading, making it simpler to understand for people who've never done it. I myself had never done it till this year, and I basically taught myself a lot of these concepts. Many of these concepts look like rocket science to me before this year, and when I started learning about them, I found them very easy, and I found that even a common man can understand it easily if explained in the right terms, which is what I've been doing. And so far I've made a good profit from share trading, and I've explained how I've done that, what kind of shares I've bought, and how I've been buying those shares. But people have been asking me about some of the common strategies that I've used. So I've divided this video into two parts. This video I'm going to explain when you buy a share, you will always notice that the buy price is different and the sell price is different. I'm going to explain what it is and why it is, and then I'm also going to explain one of the key players in share market. I mean, we saw multiple players in share market, what is shorting and other stuff. There's a key concept called market maker. So we're going to speak about the market maker, explain how the share prices go up and share prices go down in a very simple example or a very simple terminology. So in broad terminology, market makers are registered entities who basically hold the stock. They maintain a consistent inventory of the stock. Like for example, let's say ABCD, right? They register to maintain a consistent inventory of the stock, and by maintaining a consistent inventory, they're providing liquidity for the stock. Now assume there is no market maker, right? That means that if somebody wants to buy it, they literally have to wait when enough people are able to sell that quantity. Like if they want to buy 1,000 shares, they have to wait till enough people are able to sell those 1,000 shares. Like 10 people combined, they have to sell 100 shares, and this person has to wait till that point. A market maker basically acts as an intermediate entity, like a wholesaler basically, where they are able to provide the liquidity by buying and selling the shares from and to you. So when you buy the share in the market, you're actually buying it from the market maker. When you're selling the share, you're selling it to the market maker. Now there are a lot of differences, a lot of nuances. There's market maker terminology varies, legislation varies. There are slight differences, and there are so many different combinations. What I've done is I've essentially tried to simplify it so you understand the concept of what market maker is, because there is a concept called sets in the London Stock Exchange. There's a concept called normal market maker in the AIM markets, and there's so many differences. But I'm just trying to explain to you the basic concept. So I've taken the liberty of simplifying it or oversimplifying it so you understand it better. So all you need to understand now is that they hold the stock balance and then they sell it to you and they buy it from you whenever you want to sell it or buy it. Now let's take an example where there is a market maker who's trading in a stock called ABCD, and he's trying to maintain the liquidity of the shares by maintaining a balance of 1,000 shares with him. And there is a buy price and a sell price. A buy price is if you want to sell it to him and he's going to buy it from you, that is the price that he will give you to buy your shares from you. And sell prices, that's the price at which he will sell the share to you. So if you are going to buy it from him, then that's the sell price that you will have to pay to get it from him. So that's the difference between a buy price and a sell price. A buy price is what you will pay, what he will pay when you are giving the shares to him and he buys it off you, and sell price is what he sells to you basically. So let's assume someone buys 50 shares from him at the £10 price, and for simplicity I'm assuming that starting point, the buy price and sell price is the same. The spread is £0. Now the balance decreases when somebody buys from him. Is 950 shares is what he has right now, and he still has sufficient number of shares, but he knows that there is a demand. What he will do now is he'll increase the sell price where he knows that there is a demand. Now the sell price becomes £11. So if you want to buy the shares, it's £11, but the buy price is still keeping it as £10, which means that the £1 is what his profit margin is. And if you sell the share to him, he'll take it for £10, but if you want to buy it back, you have to pay £11 from him. That's a spread. The spread is £1 now, and that is his profit. And let's assume somebody goes and buys 50 more shares from him, right? Now his share balance has come down to about 900 shares. So he now knows that there is more demand, and he increases the price to £12. He increases the sell price to £12. He still has enough balance. He has 900 shares, and so he keeps the buy price the same. So now his spread is £2. So his profit margin is now increased. So he is buying the shares from you at £10, but he's selling it back to you at 12 pounds, which is a £2 profit margin. That's where he's starting to make the profit. Now, let's assume someone goes and buys 200 shares from him, right? Which now makes the balance to about 700 shares. Now, the balance is slightly below his threshold. Now, he wants to get the shares back as well. He doesn't want to go a lot below this threshold. So what he does, but at the same time, there is more demand. People are starting to buy. So what he does is he increases the sell price to 13 pounds now, where from 10 pounds it has gone to 13 pounds because 3 people have now bought it. But he also has to replenish his stock. So what he's doing is he's increasing the buy price. He's increasing it by 1 pound, saying that, okay, I was buying it off you from 10 pounds. Now I'll give you 11 pounds for your stock. So he's enticing people to sell the shares because it has gone up by 1 pound. So which means that he's trying to get the shares back also. At the same time, he's increasing the price because he knows that there is demand for this share. Now, in a rough example, there are 3 scenarios possible. One is no one has sold in the shares. So his share balance is still about 700 shares and he desperately wants the shares back. So what he will do, if nobody has bought it from him and nobody has sold it to him, after a point of time, he's going to increase the sell price, increase the buy price by 1 pound. So he's going to reduce his profit margin to 1 pound. So where it was 11 pounds for buying it from you, he'll increase it to 12 pounds. So he can get some of his shares back, which means that the margin has reduced by 1 pound, the spread is reduced by 1 pound, he's reducing his profit margin and he's offering you more money to buy the shares from you. And assume in another scenario where nobody has sold him the shares, but someone has gone and bought 200 more shares from him. The demand is more. So now the balance has gone up to balance has come down to 500 shares. He's lost half his stock. So what he will do now is basically he will try and entice more people to sell their shares because he needs to really buy it back. It has gone to a dangerously low threshold. So he now increased the buy price to 13 pounds. So from 10 pounds, he's increased it to almost 3 pounds, increased it by 3 pounds to 13 pounds, which means the share price has significantly gone up and a lot of people will try and sell it now. That is the idea. At the same time, he knows that the demand is there, but he doesn't want to lose his profit margin. So he'll sell it at 13.50, which means he's reducing his profit margin. The spread is now 50 pence, which means that people will be more ready to sell it to him because the profit margin they can see is very less. The buy price and sell price is like almost coming closer together, which means he's really wanting your shares more. So when you see the profit margin spreading, which means that the demand is low, but he has enough quantity, so he's trying to make more profit. When you see the spread coming down, which means that he's trying to get the shares from you. Now another scenario is where assume that somebody has now sold the shares and nobody has bought it, which means that the share balance has gone to about 900, and which has gone back to the same scenario. So he'll take it back to the original spread, where he'll keep it at buy price as 11 and sell price as 13. So the spread is still 2 pounds, and which means that he's just going to maintain it that level till the inventory balance or the share balance goes up and down. So this is kind of a rough example as to why he will increase the share price or why he'll decrease the share price that he will buy from you or he'll sell to you in a normal market scenario. Now assume the same thing in a good news scenario and a bad news scenario. Now in a good news scenario, again, let's assume that you start with a 10 pound spread or 10 pound buy price and sell price, and he is expecting that there is a good news that is going to come, which is the market maker always knows the market much better than the shareholders. So they know that the good news is going to come and the price would normally increase, the demand will normally increase with the share price. Now this is where it gets tricky, where sometimes what the market makers will do is they know what the stop loss is. Stop loss is basically people when they buy a share, assume 10 pounds, and they are like active, they're going out to beach, going out to the market and doing their stuff. They're very busy that if it falls drastically, they don't want to have a big loss. So what they do normally is they put a stop loss, which means that if I bought it for 10 pounds, I don't want to lose more than 30% of my share value, which means that they'll put a stop loss at 7 pounds to say that if it goes down below 7 pounds, sell all my shares or sell 80% of my shares so that I don't make a big loss. That's my loss appetite. Now, sometimes the market makers can see an average stop loss scenario what they'll do is they'll drastically reduce the price. Now, they'll not reduce it 9 pound, 8 pound, 7 pounds. They'll basically bring it down from 10 pound to 7 pounds because they want more shares. They want to hold more shares. They know the demand is going to be higher sooner. So they'll basically drastically reduce the share prices to, let's say, 7 pounds, and the stop losses will kick in. A lot of people will start selling their shares, or a lot of automatic sales will happen. They will buy these shares at 7 pounds and they'll accumulate their balance and they'll take it to, let's say, 1500. Now, when he has enough, he'll bring it back to the normal prices, but he won't take it to the 10 pounds now. So he knows that he's anticipating buying needs, and good news is also going to come in. So he'll combine the two. He'll increase the sell price to 12 pounds and he'll keep the buy price at 9 pounds because he has enough shares. So which means that the people, when they go and buy the shares from him, they'll see that it's increased by 2 pounds, and good news will also hit, which means that people will start buying more, and he has enough shares now to bring it down. So he will play it down till he goes down below the threshold, and that way he's basically, even though there was a good news expected, the share price has suddenly dropped because the market maker has played it. Now, again, similar scenario when bad news is expected. He knows that a lot of people are going to basically sell their shares. So what he'll try and do is he'll try and reduce his stock and keep it reduced, so that when a lot of people try and sell it, he will basically be able to get the shares back and maintain balance. So he will just reduce it enough so that it is around it is enticing people to buy it from him. So he'll keep the spread zero, but he'll basically reduce the sell price, which means that they will look at it as an opportunity to buy the share because they're seeing the prices come down slightly, which is looking like a discount. So people will start to buy the shares, and when it comes down to a certain point, like it goes down to 500, and the bad news is also hitting at that point, he will then basically drastically reduce the buy price, which means that it's triggering people to sell more shares. And he'll keep the sell price as the same, which is already down. So that way, people are basically selling a lot more. Bad news is hitting. The share price is also dropped. People will sell a lot more, and he will get back the shares that he has actually sold by manipulating the market. So market makers do a lot of market manipulation, but a lot of this is legislative control. So like I said, the market makers are heavily regulated. There's a lot of legislation, and every country has got slightly different variations of the scenarios. But I just try to simplify or oversimplify the concept of market makers, the concept of why share prices go up and down, and why the spread is different between the buy price and the sell price when you want to buy it or when you want to sell it, why the price is different, and how sometimes even a good news means that share prices can drop to an extent before it starts picking up again. Why you will see when the share price is going, and with the good news, when the share price is going well, suddenly there's a drop in price before it picks up again because the market makers are trying to get the stock from you. So there are a lot of manipulations that happen. So which is why it's important to understand these concepts, because this could mean the fluctuation in the shares, and you don't need to panic. Like if the share price suddenly drops, don't panic. Understand that there's a lot of play that is happening behind the scenes. So that will help you react to the shares a lot better, knowing these things behind the scenes and knowing that how the good news and the bad news affect the share prices and how they affect the market. So hope this was useful to you. In the next video, I'll be covering some of my strategies, some of my tips, how to avoid losses in share trading. And thankfully, using these tips or using these strategies, I have been avoiding huge losses or big losses, and I'm making small profits and big profits. And overall, my share trading has been profitable for this year. And I'm a beginner. I'm a complete beginner. I don't use charts. I don't use candles. These strategies have all been helping me doing what I've been doing. So I'll be sharing it with you in the next video. Thank you. Bye.